Hey Econ students, we are finishing up part 2 of macro measures, which is basically just finishing up our discussion on GDP. So we want to talk about how we calculate GDP, how it is actually counted. So there are 2 ways. There's the expenditures approach and there's the income approach. The expenditures, you count up all the spending on items that have been produced. So everything that everybody spends their money on, you count up all that, and then that'll tell us the dollar value of things that are produced. Or you can do the income approach, where you add up all the income that results from selling all final goods and services. So all the money that businesses make from it, basically, count all of that up, and that'll give you the dollar value of everything that's been produced. And ideally, either way, whether you use the expenditure approach or whether you use the income approach, the same number will be generated. For this course, you need to know how to count with the expenditure approach. You need to know that income approach exists, but the one you actually have to calculate yourself is the expenditure approach. So let's take a look at that one. So, expenditures approach, again, we're counting everything that's been spent on items that have been produced and adding all of that up. So we categorize all of the spending into 4 different categories. First, there's consumer spending, and that's what you and I and normal private people buy. So it's purchases of final goods by private individuals. Like when you go to Subway's and you pay $5 or $6 for a sandwich, that's consumer spending. That makes up about 70% of GDP in the US. Then there's investment. Investment is business spending. One more time, investment is business spending. Again, investment is business spending. It's business spending on tools and equipment. Like when Walmart buys those self-checkout machines, that's business spending. That's investment. That makes up about 15% of US GDP. And then there's government spending, whatever the government is building and spending money on, that makes up about 20% of GDP. When they build a school or they buy a tank, all of that stuff is business spending. It does not include transfer payments. So when they spend money on Social Security or they give money for welfare checks and things like that, nothing's being produced, so that doesn't count into GDP. It's just business spending on products, things that have been produced. And then 4 is net exports. So this is basically foreign spending, what other countries are spending on our products, but you have to subtract what we spend on other countries' stuff. So we call it net exports. Exports are things that we sell to other countries, minus the imports, the things that we buy from other countries. So exports minus imports equals net exports. And that's the value of what foreigners have spent on our goods minus what we've spent on theirs. So if, in a small scale example, it'd be the value of 3 Ford Focuses minus, built here in the US, minus 2 Hondas built in Japan. So these are the 4 categories or components of GDP: C, I, G, and XN. XN stands for net exports. So GDP equals C plus I plus G plus XN. This formula, this components of GDP needs to be etched in your brain. We will use it for way more than just calculating GDP. All right, you also need to know about the difference between nominal GDP and real GDP. Nominal GDP is GDP that is measured in current prices. It does not account for inflation from year to year. So you all know that prices have gone up in your lifetime, in my lifetime, in my parents' lifetime, in my grandparents' lifetime. When my mother went to McDonald's, she could get a cheeseburger for 5 cents when she was in high school. And now they're $1.29 or something like that. That's inflation. And it's not just inflation for cheeseburgers or just gas, it's a general rise in price level across the board of everything. So when prices go up, that kind of makes GDP a little inflated. Because we could remember GDP is the dollar value of all goods that have been produced within a country's borders, all final goods that have been produced in a country's borders in 1 year. If we're using the dollar value of that year's goods, the prices might be higher than the year before, or the year before, or the year before that, and it might inflate the GDP, making it look higher than it really is. So that's why we have real GDP, which shows us GDP expressed in constant or in changing dollars. Real GDP adjusts for inflation. So we pick a year and say, we're gonna put all the GDPs from every single year, we're gonna use a base year's price. Let's just use 2015. And we'll compare everybody's GDP, every year's GDP to 2015 prices. And that way all the prices are constant, and we can really tell whether more or less was produced because we're using the same prices for every single year. So again, inflation is the rise in the general level of prices. Real GDP is the best measure of economic growth. Remember, the whole point of this unit is to see if we grow, because the goal of the economy is to grow the economy, and GDP measures growth, but it has to be real GDP. If we use nominal, we can't really tell whether the prices went up or whether we produced more. So we have to use real GDP. Okay. Here is an example of real versus nominal GDP. So let's say in 2017, there's this little tiny country, and all they made that year was 10 cars and 10 trucks. And in 2017, the 10 cars cost $15,000 each, and the 10 trucks cost $20,000 each. And if that's the only thing that the country made, then we add up the dollar value of everything that was produced. So 10 times 15,000 is 150,000. And 10 times 20,000 is going to be 200,000. So that's the dollar value of the cars that were produced. That's the dollar value of the trucks that were produced. We add those two together, and GDP that year is 350,000. So if this is the only thing that that country produced, then this is their gross domestic product for that year. So again, nominal GDP in 2017 shows the dollar value of all final goods and services produced. So the dollar value of the cars and trucks that were produced was $350,000. Then in 2018, they did 10 cars, but the price was $16,000, and they did 10 trucks, but the price was $21,000. So if we do the math again, the price of the cars will be $160,000, and the price of the trucks will be $210,000. And then we add those two together, and we have 370 as our nominal GDP. So nominal GDP in 2018 is higher, 370 as opposed to 350, which suggests that the economy is growing, but it's really not true. Because how much is real GDP for 2018? How do we figure it out so that we compare them equally? We got to use 2017 prices. So I take the amount of cars that were made in 2018 times it by the price for 2017. So 10 times 15 would be 150,000, and 10 times 20 would be 200,000. So real GDP in 2018 is 350,000. So we're using the amount of things that were made in 2018 times the prices in 2017 to get real GDP. So we have a constant price. We use those 2017 prices. Now, did the economy grow? It was 350 and it still is 350. There was no growth. It looked like there was growth because the prices went up, but it wasn't really growth because real GDP shows that it was the same number. So real GDP deflates nominal GDP by adjusting for inflation in terms of base year prices. So this real GDP number deflates the nominal number by adjusting for inflation by using a base year price. In this case, we use 2017 prices. So we'll practice some more on that later, but that's how it works. And then the last thing we need to work with for GDP is the business cycle. So business cycle is another graph that you need to know. I want you to draw this in your notes and know it well. We'll work with it a lot. But so it's a graph that's comparing GDP and time. It could be years, it could be months, but we'll just put time here for now, just in general. And what it's saying is that GDP, this black line here, GDP goes up and down over time. Sometimes we have high GDP, sometimes we have a lower GDP, sometimes it goes up again, but it goes up and down like a roller coaster. So the business cycle is the roller coaster of GDP, of a country's GDP, going up and down. And we know that in our lifetime, in 2006, 2007, we dove down into a recession, and then since then we've been going up and increasing our GDP so that we have a similar thing going on. And this over time, you can see it, you can document it. So when we are high at the top of the roller coaster, we call those peaks. So this is a peak, this is a peak, this is a peak up here. Down in the bottom, when it comes down, this is called the trough. Down here, this is also called the trough. And then when we are going down from a peak to a trough, that is called recession. And just to be clear, recession is a 6-month period of decline in real GDP. It has to be 2 quarters worth of time in order for it to be called recession. If we just go down for a month, it doesn't count. But if we go down for 6 months or more, then we call that a recession. So this downward movement is called a recession, or sometimes economists will call it contraction. The economy is contracting or getting smaller. And then when we're going up from a trough to a peak, that is called recovery, where we're getting more and more GDP, or other economists will call it expansion. The economy is getting larger. A couple other things you need to know. This green line coming through, we call that the trend line. Over time, we know from 100 years ago to now, we have grown. We've gone up and down throughout that time, but over time, totally, we are continuing to grow. So that growth trend line is this line going through the middle. We call that the trend line. When a country is above its trend line, we're up on a peak above this trend line, we call that time period an inflationary gap. And when we're below the trend line down here in a trough, we call that time period unemployment, or a recessionary gap. So those are just some things you need to know about this. I take some time to draw it, and we'll work with it a little bit more when we do some practice. That is it for macro measures part 2, and we're good with GDP, and we'll just spend some time practicing.